Welcome to Breaking News to Trading Moves. Imagine dropping a $1.75 trillion boulder into a small pond.
That is a very big boulder.
Right. The splash doesn't just get you wet, it completely rearranges the shoreline. And that is exactly what we are looking at today. So SpaceX has reportedly set a $135 IPO price.
Yeah, aiming to raise around $75 billion.
Exactly. Which gives SpaceX a valuation of roughly $1.75 trillion. So if this proceeds as planned, it immediately makes SpaceX one of the most valuable companies listed on a U.S. exchange and, potentially the largest IPO in history.
Yeah, that valuation number alone commands immediate attention from, well, pretty much every corner of the market. But the mission of our discussion right now is to look at the cross-section of themes that this event touches.
Because it's not just about space.
No, not at all. We're looking at a single company that operates across space launch, satellite internet, defense technology, telecom infrastructure, private capital, retail investor demand, and, of course, Elon Musk's market influence.
Yeah, it really touches everything.
It does. So we are going to analyze the direct mechanics of how a listing of this magnitude forces the rest of the market to react.
Which brings us directly to what this means for public market traders. We are going to strictly evaluate the market winners and losers here. So think of this IPO like a massive new superstore opening up in a neighborhood.
I like that comparison.
Yeah, so we are just looking at which surrounding shops get more foot traffic and, well, which ones lose customers. We're focusing strictly on the trading facts. We are not looking at the rockets themselves. We are looking at the cash moving around them.
Exactly, because when a $1.75 trillion asset enters the public arena, capital just has to rearrange itself. It has no choice.
Right.
So the first place we see this reorganization, and our first category of winners, is within the broader aerospace and defense ecosystem.
Okay, the legacy guys.
Yeah, the legacy contractors. Even though they operate very differently from SpaceX, an IPO of this size brings immense investor attention to the entire sector. The market often begins repricing anything connected to launch systems, defense contracts, satellites, space hardware, and, national security technology.
Okay, let's put some specific letters to that concept for the listeners.
Yeah.
For aerospace and defense infrastructure winners, traders are watching tickers like BA for Boeing, LMT for Lockheed Martin, and NOC for Northrop Grumman.
Those are the heavyweights, yeah.
But I have to play devil's advocate for a second here.
Go for it.
Well, these are legacy, old-school defense contractors, right? SpaceX is famous for undercutting them on price and just innovating way faster. So why does a massive win for SpaceX translate into a win for Boeing or Lockheed Martin?
That is the exact paradox that most retail traders get trapped in. You really have to understand the mechanics of how institutional capital operates.
Okay, break that down for us.
So when a massive catalyst like a $75 billion IPO hits the calendar, generalist tech investors...
Like the guys buying software stocks.
Exactly. The people who normally buy software or consumer electronics, they suddenly need to understand space and defense because they are researching SpaceX.
Oh, so they're forced to look at the whole sector.
Right. And when they look around the sector, they start hunting for comparable investments. They look at government budget allocations for space defense. They analyze orbital hardware contracts. And, well, they see companies like Lockheed Martin and Northrop Grumman holding those highly lucrative long-term contracts.
So it is almost like a giant educational marketing campaign for the entire industry.
That's a perfect way to put it, yeah.
The big money managers are forced to learn about space defense, and in doing so, they realize the legacy players still have guaranteed government cash flow.
Precisely. That fresh institutional attention can lift valuations across the board. Furthermore, portfolio managers operate with strict sector weightings.
Okay, what does that mean in this context?
Well, if space and defense suddenly becomes validated as a premium high-growth area by the broader market, funds will increase their overall weighting in that specific sector.
And they can't just dump all that new money into SpaceX.
No, they cannot put all of that newly allocated sector money into just one stock, even one as large as SpaceX. They spread it across the established players, which creates a rising tide for BA, LMT, and NOC.
That makes a lot of sense. Now, we also have satellite and space communication winners in this first group. Here we are looking at tickers like ASTS for AST Space Mobile, GSAT for Global Star, and IRDM for Iridium Communications.
Yes, and this group sees a major boost because Starlink makes satellite internet a core part of the SpaceX story.
Because they're not just building rockets anymore.
Exactly. SpaceX is not just a rocket company, it is a global communications provider. As traders analyze the revenue multiples of Starlink.
Meaning how much investors will pay for every dollar it makes.
Right. As they analyze that, it drives speculative attention toward other space communication names.
I need to pause you right there, though, because I have a serious question about that logic.
Okay, what is it?
If SpaceX is the dominant player, and Starlink is arguably the most capable satellite internet constellation ever built, why wouldn't investors just abandon these other aerospace and satellite companies entirely instead of giving them a sympathy boost?
That's a fair point.
I mean, going back to my superstore analogy, if the superstore has literally everything, why shop at the boutique? Why are ASTS or Global Star getting a boost when the undisputed heavyweight champion is entering the ring?
It is a totally valid question, but again, we have to look at the structural reality of government and commercial procurement. Clients actively avoid monopolies.
They don't want all their eggs in one basket.
Exactly. The Department of Defense, for example, operates under strict mandates to maintain a robust industrial base. They will always fund secondary providers. They just cannot have a single point of failure for national security communications.
Oh, wow. So they literally spread the money around on purpose just to keep a backup option alive.
Yes, and traders know this. Capital flows into the secondary players like Iridium or Global Star because the market anticipates those contracts will be awarded specifically to ensure SpaceX isn't the sole option.
Right. The government needs them to survive.
Plus, when investors see the massive valuation assigned to Starlink, they start hunting for the next company that might secure even a tiny slice of that orbital communication market. If the total addressable market is proven to be as lucrative as Starlink suggests, even the second or third place competitors become highly valuable assets.
Okay, that clarifies things entirely. The government explicitly wants multiple ships kept afloat, and the market prices in that reality.
Exactly.
So let's move smoothly over to our next group of winners, which involves the specific mechanics of how retail investors actually access this IPO.
Right. We are talking about trading platforms and retail brokerages.
Because the structure of this IPO is pretty crucial here.
It really is. SpaceX may give retail investors a much larger role than usual in the IPO allocation. A high-profile Elon Musk-linked IPO naturally drives massive retail trading activity.
Oh, absolutely.
Retail demand for this specific equity is just expected to be staggering.
So for this category, the specific tickers you want to watch are HOOD for Robinhood, SCHW for Charles Schwab, and IBKR for Interactive Brokers.
Those are the main players, yeah.
And to me, these platforms act exactly like the toll booths on the highway. They don't need to build the rocket. They don't even need to care if the rocket reaches orbit. They just process the traffic of retail demand wanting a piece of the IPO.
That toll booth analogy perfectly describes their business model. Brokerages generate revenue through very specific mechanics, like order flow, margin lending, and sheer trading volume.
Just from people making moves.
Yeah, when an event captivates the retail trading public to this degree, you see a measurable surge in new account creations. People who haven't traded in years will log back in, deposit fresh cash, and place orders.
And how exactly does that translate to the bottom line for a company like Robinhood or Schwab? Can you break down the actual mechanics of that revenue?
Sure, there are three main levers here. First is transaction velocity. Even if commissions are zero, brokerages earn fractions of a cent on routing those massive order volumes.
Right, the whole payment for order flow system.
Exactly. Second is margin. In a highly anticipated IPO, traders often borrow money from their brokerage to buy more shares. The brokerage charges interest on those margin loans, and, well, a high-demand stock drives margin balances through the roof.
Wow, okay. And the third lever?
Third is uninvested cash. When billions of dollars are deposited into brokerages by retail investors hoping to get an allocation of shares, a lot of that cash just sits idle.
That's like they can't get all the shares they want.
Right. So brokerages sweep that uninvested cash into interest-bearing accounts and pocket the yield.
That is wild.
It is. So Interactive Brokers, Charles Schwab, and Robinhood all benefit directly from this transactional velocity and cash hoarding.
So these brokerages are raking in cash just by providing the infrastructure for the retail frenzy. But, that massive pile of retail and institutional cash flooding into SpaceX has to come from somewhere, right?
Absolutely. It doesn't just appear out of nowhere.
Right, it's not new money being printed by the Federal Reserve, it's being pulled out of other investments. So who is bleeding that capital right now?
That brings us directly to the companies that face immediate headwinds from this news.
Yes, we're moving into the losers category, starting with public space peers. The tickers facing headwinds here are RKLB for Rocket Lab, SPCE for Virgin Galactic, and LUNR for Intuitive Machines.
This is where we see a severe comparison problem in the market. Before SpaceX goes public, if a portfolio manager wants exposure to the pure-play space economy, they have a pretty limited menu.
They have to just take what they can get.
Exactly. They have to buy smaller, often more speculative companies like Rocket Lab or Intuitive Machines. But once SpaceX enters the public market, it creates a formidable valuation comparison risk.
What exactly is comparison risk in this context?
Comparison risk happens when a dominant, high-quality asset suddenly becomes available in a sector that only had lower-quality options previously. Investors will literally ask their analysts, why are we holding shares of a highly speculative space name with inconsistent revenue when we can now own the absolute category leader?
The one that actually lands reusable rockets every week.
Exactly. Why take the risk on the small guy?
It is the harsh reality of capital allocation. The local contenders suddenly look much less appealing when you can just buy the undisputed heavyweight champion.
Yeah. The liquidity dries up for the smaller names because the premium capital moves to the premium asset. The market simply abandons the speculative trades because they no longer need them to gain exposure to the space theme.
That makes perfect sense.
And now, staying in the losers category, we have to look at an area that might surprise some people: telecom and broadband incumbents.
This one is absolutely fascinating. The tickers here are T for AT and T, VZ for Verizon, TMUS for T-Mobile US, and CHTR for Charter Communications.
Right, the traditional giants.
Yeah, and for everyone listening, you might be looking at your monthly cable or phone bill right now and thinking a rocket company in Texas has absolutely nothing to do with your internet connection.
It seems completely disconnected at first glance.
Right. So how does Starlink change the way we define a broadband provider?
It alters the entire infrastructure narrative of the telecommunications industry. For decades, the primary barrier to entry in telecom was the staggering physical cost of infrastructure.
You mean laying the actual cables?
Yes. To compete, you had to spend billions laying thousands of miles of physical copper cables or fiber optics in the ground, or negotiating real estate to build cell towers across the continent.
Right. Nobody is going to dig up my entire neighborhood just to offer me a new cable package. Yeah. The physical cost is just too high.
Exactly. AT&T, Verizon, and Charter built massive, supposedly impenetrable business moats based on that physical infrastructure. But Starlink beams connectivity from low Earth orbit directly to a receiver dish on a house.
Completely bypassing the terrestrial network.
Exactly. When traders realized that a company in orbit can suddenly compete for rural and suburban broadband customers without digging a single trench or laying a single mile of physical fiber, the valuation models for legacy telecom companies have to be adjusted downward. The terrestrial moat is structurally compromised.
That is a brilliant way to frame it. The moat used to be measured in thousands of miles of buried wire.
Right.
And overnight, the moat becomes who can manufacture the most capable low Earth orbit satellite. The physical ground game becomes a liability rather than an asset.
That's exactly how the market starts to view it.
So the market starts pricing in the loss of future subscribers for T, VZ, and CHTR before those subscribers even call to cancel their terrestrial plans.
Yes. The stock market is a forward-looking mechanism. It doesn't wait for the earnings report showing subscriber losses. It prices in the probability of those losses the moment the competitive threat is validated. A $1.75 trillion valuation for SpaceX validates Starlink as an existential threat to terrestrial broadband.
Wow, that is intense. Which brings us to our final group of losers, which involves the broader mechanics of how money moves around the entire stock market. We are looking at high valuation growth and IPO competition.
This is purely a matter of market physics. A $75 billion SpaceX IPO absorbs a massive amount of investor attention and capital.
It just sucks it all up.
Exactly. That creates heavy downward pressure on other growth names as investors rotate into SpaceX as the new premium growth story.
Right. And the specific tickers feeling the pressure here are TSLA for Tesla, COIN for Coinbase, RIVN for Rivian, and SOFI for SoFi.
Now, you might wonder why a crypto exchange like Coinbase or an electric vehicle maker like Rivian would drop because a space company goes public.
Yeah, they seem totally unrelated.
Well, it has nothing to do with their business models and everything to do with portfolio construction. Think of the stock market like a solar system, and SpaceX is a newly formed gas giant. A $1.75 trillion valuation has immense gravitational pull.
Oh, so it literally pulls liquidity and institutional cash out of the orbit of smaller tech companies. Like, going back to my limited budget for a night out analogy, if investors spend all their capital on the most expensive, highly anticipated ticket in town, which is SpaceX, they just have less capital to allocate to other high-growth tickets.
That is a perfect analogy.
Let's get down the mechanics of that gravity, though. Why do portfolio managers have to sell those specific stocks?
Asset managers do not have infinite cash. They manage strictly defined portfolios grouped by risk. Tesla, Coinbase, Rivian, and SoFi all occupy what is known as the high beta aggressive growth segment of institutional portfolios.
And for you listening, high beta just means these are the highly volatile, aggressive growth stocks that swing much harder than the rest of the market. Asset managers treat them as a specific bucket of risk.
Exactly. They have a strict risk budget. If a portfolio manager wants to buy a 2% allocation of SpaceX to capture its growth, they cannot just ask their clients for more money. They have to sell 2% of something else within that same high beta risk bucket to fund the purchase.
Oh, wow. So they're literally forced to sell.
Right. As hundreds of funds simultaneously free up cash to participate in the SpaceX IPO, those specific names, Tesla, Coinbase, Rivian, SoFi, they experience concentrated selling pressure. It is a direct mechanical rotation of capital from the old growth darlings to the new one.
And this is exactly the structural reality that retail traders often miss when they just look at a stock in isolation. You might be holding Rivian and wondering why it is dropping on a Tuesday with no bad news, completely unaware that a massive IPO 3 sectors over is sucking all the oxygen out of the room.
Which brings us to the main trading takeaway from this entire event.
Yeah, what's the bottom line?
For traders analyzing this landscape, the key is to avoid treating every space-related stock or high-growth tech stock the same. You have to analyze the specific underlying mechanics of each company's relationship to this IPO. Some names get a sympathy boost because they operate in complementary defense lanes or, benefit from government anti-monopoly mandates.
And brokerages win purely on the velocity of retail trading volume.
Exactly. Meanwhile, others suffer severe capital drains because SpaceX becomes the stronger, cleaner way to trade the space theme, or because it forces portfolio managers to liquidate other high-beta holdings.
It is all about knowing whether a stock is acting as the toll booth, the legacy competitor with a compromised physical moat, or the secondary contractor that the government refuses to let fail.
Correct. The market is an interconnected ecosystem of capital, and an asset of this size demands a reorganization of that capital across multiple sectors.
As we wrap up this analysis, here is a final thought to mull over. If a single private company can absorb $75 billion in public capital and simultaneously alter the established narratives across national defense, telecommunications infrastructure, and high-beta growth portfolios, how does this force us to reconsider what defines a tech stock in the modern market? Are we reaching a point where aerospace engineering and orbital manufacturing replace software as the ultimate drivers of market value? This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.